Are you recalibrating your rate cut trajectory in a post-Waller world? Good morning.
Good morning, Manus. Okay, so no, we're not recalibrating. I actually think that what we're expecting is very much in line with what you've just heard from a number of analysts on the street. What we're saying is, in terms of how the market is pricing rate cuts for this year, it is too soon. Too soon. March is very, very premature to think about rate cuts. At the same time, and probably more important in terms of the timing of that first cut, is how many cuts. Now, we would say that 6 to 7 rate cuts only happens if you've got a deeply negative economic backdrop, which we're not anticipating. But because inflation is coming down, it's going to come down fairly wobbly. It's not going to come down in a straight line, but it's going to get closer to that 2% level. And around mid-year of 2024, we are expecting the Fed to be ready at that point to start cutting interest rates, but to go very gradually. So we're only expecting 3 cuts for this year. So not a change in the forecast. I think at the end of last year, the market was just far too optimistic. And at this point, you can only get slightly bad news for the market.
How does risk, how do you think asset managers, fund managers, how do you think people look at risk in this first 6 months of the year? Seema.
So I do think that the first 6 months of the year are going to be marked by a fair amount of volatility. As a year as a whole, we think it's a decent year. We think risk does okay, certainly not as well as you saw in 2023 for equities, but it's still a positive year. But in the first part of the year, because there's going to be so many question marks about when does that rate cut come, that debate continues and it's going to rile the market. And I think Jim and I have a very similar theme going on. We're talking about it in slightly different ways. But at the end of last year, all the good news was priced in.
Yeah.
A soft landing and early rate cuts. And from there can only be disappointment. And I think so that's why you get volatility. And I think for asset managers, it's important to look through that volatility and focus almost on that medium term into what happens once you do get those rate cuts and how do equities and credit and certainly alternative assets perform. And I think for us, it's certainly a time for diversification, but still leaning into risk.